going in, recording from my childhood bedroom. It really is Thanksgiving week. Travel's coming up. I hope everyone has an excellent holiday season for whatever you celebrate. Rob is in New York City. Some very exciting life updates on his end, but I won't spill his tea. I'll let him do that on his own time. That said, welcome back to the show, the Lone Star Capital Podcast. Craig McGrouther here, the Director of Business Development, alongside Rob Beardsley, the CEO of Lone Star Capital. We got a fun show for you today, but before we get into it, just want to remind everyone that if you have questions for us, if you have comments for us, if you want feedback, direction of the show, please comment, leave a review, comment, if you would, so we can get further direction to make this show about you guys, because it is all about the listeners. We obviously want to talk our book. We want to explain what's going on our end, give you kind of a taste and flavor within our world, but this show is revolving around the listeners. So if you're a listener, you want certain themes, items, or topics to go through, please let us know. We'll be happy to accommodate it, assuming it's a good thought. Another thing, if you're an investor or if you're a fund manager looking to learn about our products, what we're doing, how we see the world, what we're up to in 2024, what we've done this year, and what we're going to be doing in 2025, please reach out to myself so I can kind of give you the latest and greatest what we're doing. And if we can find a path to work together, that'd be incredible, assuming there's a mutual fit there. So email me, craig@lscre.com. So once more, if you're a fund manager or an investor looking to learn about us, please reach out to me, Craig, CRAIG@lscre.com. If you're watching this on YouTube, please subscribe to the channel, like it, the whole nine. We really appreciate it. Stuff like that will help us grow. I feel like this show so often, actually, the emails we get, the comments we get, the calls we get are investors, people who find out us from YouTube or LinkedIn, then they go to YouTube or they go to the podcast, Apple, Spotify. They find us and they say, I don't know how everyone doesn't listen to your show. So help us, please. Send this to people, like it, review it. That will help the growth. We're doing this really for the love of the game, not for the status of the clout, but if more people watched it and listened to it, that would be appreciated. So please, please, please share this, comment, do your thing. If there's something you don't like, let us know. I have thick skin. It's getting to me, not my co-partner here, Rob. But we're looking to get better here incrementally 1% a day. But with that said, let's get into the show. Let's talk about, to start, we were looking through our 2023 year-end, how would you explain it, Rob? The year-end
Annual
report?
letter.
Annual letter, exactly. As you are looking to probably draft and conduct your 2024 year-end letter. But let's go through, if you want to screen share, do your thing, talk about some of the concepts and principles from the 2023 year-end
Yeah,
review.
absolutely. Let's do it. So I'm going to go ahead and share my screen. So this was the 2023 Lone Star Capital Annual Letter. You can find this available on our website at lscre.com under Insights, Articles. We frankly have not been posting articles consistently anymore. So who knows, maybe we'll get back to that. But if you do go to articles, the very first one is the Lone Star Capital 2023 Annual Letter. So since we're approaching the end of 24, it's interesting to kind of do some reflection. And before we reflect back on 2024, it's nice to look back on 2023 and look back at just a summary of that year, as well as what our outlook was for 24. And then we can kind of look and see, okay, what was our outlook at the end of 23 for 24, and how does that compare to reality? And then how does that guide us in our future vision? Because now we have the benefit of hindsight. And now, as we look forward to 2025, we have obviously the experience of 2023, looking forward to 24, the conclusion of 24, and so on. So without further ado, just recapping 23 very briefly, we had a very ambitious goal, a too ambitious goal of 350 million in acquisitions. It's
a big number.
It's a big number. And as we've learned over time, there's benefits as well as downsides to setting really high goals. You know, a lot of people talk about aim for the stars, get to the moon, or whatever the saying is. And so it's usually never a bad thing to have very lofty goals, because even if you fall short, you still made it very far. With acquisitions, it's difficult. It's a little more nuanced, because you don't want to necessarily shoot for the moon and have a really lofty goal and try to accomplish it at all costs. You know, we all know that there's a bit of a perverse incentive there, or you can get yourself in trouble, because at the end of the day, the very best deal that we could ever do is walking away from the wrong deal. So, and that's a lot harder to do when you've got a really lofty goal like 350, 400, 500. We want to be the most active buyer in the country, whatever the goal is. It's dangerous because it can force you to compromise on your standards and make a bad decision or do a deal that you really shouldn't, or finance it a certain way, etc. So,
Yeah, when you think about getting greedy here, I think the people that are in the most trouble right now through this point of the cycle are those who got way too quick in scale. And some people even say to us, hey, you scale too quickly. Or, I guess not said to us, but I've said, oh, did you scale too quickly? How have you accommodated the growth? And although we've kind of had our growing pains, which we're really working through this year, it's kind of interesting that the groups that are kind of selling and that are kind of on the bingo cards of, groups that are most messed up, not gonna name any names, but they got way too hot. They bought too many properties, and now they're dealing with the ramifications of that, and they're not able to acquire during this really sweet opportunity, but they bought at the top of the market. And it's just, one thing that we really want to do here at Lone Star Capital is we'd rather, we'd rather have one too few deals a year than do one too many deals in a year, because that extra deal or two a year that maybe you pushed on a little bit too much, you got a little too aggressive on, that's the deal that drags down the morale of the team. It makes investors question you in the future if they're in it. And there's so often deals, actually, it's kind of interesting, Rob, you'll appreciate this. There's deals that certain capital raisers are in or could be in that is maybe the first deal with you. They see how it goes. And if it doesn't go right, you might never work with them again. And that's a responsibility that we take super seriously at Lone Star Capital. If you're an investor or a fund manager, it's very important to make sure that, they look to us as the experts, and they are staking their reputation and their ability to even raise capital indefinitely off the backs of our decision making and underwriting. So that's a incredibly big responsibility that we need to take life and death serious. And that's something that, we learn along the way. We are fortunate to be really secure and stable throughout the portfolio, but I'm just very grateful that we are in the position that we're in, because one wrong move, one wrong deal, and you may never have the right and the honor and the privilege to work with said investor or fund manager again.
that's a really good point, and I think that's something that's actually, funny enough, not talked about enough. There's like a lot of things that are talked about a lot that are similar to this topic, but the concept that, and you hear me talk about this a lot, I always say life's an audition. Everything is always an audition, right? We're constantly auditioning. And the thing about doing deals like what we do on a deal by deal basis is we don't have the benefit of an average, right? It's not like we invest a fund. So an investor places their capital
Blind
into a
pool.
fund, and
Yeah.
then we go buy 10 deals, and if one of those deals is a dud but 9 do well, the average performance is great and the investor's super happy. We don't have the luxury of that average. We have to be good every single deal, because like you said, we might have a new big investor, we might have a new big partner join us on X particular deal. And like you said, if that deal doesn't turn out to go to their satisfaction, whether it be stumbling blocks on the initial performance or market changes, or debt goes the wrong way, or our communication isn't good and they don't like the way we handled something, that could ruin that relationship and that opportunity forever. So we have to be good every single deal, because of the nature of our business is deal by deal acquisitions, right? Like you said, it's very rare for an investor to go in on someone, like take a gamble with trusting us on a deal and it not going well, and they'll go, you know what, I'll ante up and I'll try them out again, right? That's just
Yeah, you
not
have to
realistic.
be, yeah, you have to be maybe the coolest person in the world, have some really unique pitch that is uh, wildly dynamic in order to get someone to re-up with you again if the first go around did not go so well. Because unfortunately, for the better or worse, people have a bias there. We have some capital partners on our deals. The cash on cash is just a little bit lower than what we were projecting. Fortunately, they're still distributing deals, but until kind of the completion of those opportunities, they're just going to be a little bit more, I guess, cautious to re-up with us again, and that's okay. But we will earn their business again from how your efforts have been and the team efforts have been. So this is just part of the cycle.
Yeah, and I don't want to get too distracted away from the contents of
Yeah.
the annual letter, but one other point on that is, and you said this yesterday in a different context, but you never want to let a crisis go to waste, right? That's what they say. And I think it's important to remember to not freak out and lose a ton of sleep over a difficult situation, because in fact, difficult situations provides the opportunity to prove yourself. And so when we've been in difficult situations where complexities arose during the escrow period and we had to find unique ways to overcome those challenges to get to the closing, or during the deal there were some issues with, the tenant base or evictions and things of that nature, those are opportunities for us to show who we truly are via communication, transparency, honesty, hard work, and actually solving the problem, right? If there's never a problem and then you never have the opportunity to show your abilities as a solution creator. So that's the other thing too. If there are issues, they are just simply opportunities. But anyway, without further ado, let's dive back in. So basically, we had the lofty goal. We talked about the dangers of such a lofty goal. 2023, as many know, there was a very wide bid ask spread because it was a very volatile interest rate environment. Rates went up a lot. Cap rates were slower to adjust. And so basically, there was an imbalance there between the cap rates that buyers wanted to purchase property at and the cap rates that sellers wanted to sell property at. So we couldn't find a ton of great deals, which is totally fine. We chugged along and did 5 deals in 2023, totaling $145 million in acquisition volume. And notably, we acquired our first property in Dallas. We wanted to enter Dallas for quite a while. Our investors were really pushing us to invest in a market outside of Houston. They like us, they like Houston, but as you can imagine, some of our investors were becoming over allocated to one particular market with us. And so they said, hey, we want more Lone Star deals, but we need something aside from Houston so we can be diversified. So we were able to do our first Dallas deal in 2023, which is great. And, little sneak peek to 2024, earlier this year, we did buy our second Dallas deal. So it's nice. Hopefully we can get at least one, maybe 2 more deals in Dallas next year and slowly build up that portfolio. I think it's interesting to note how challenging it really is to break into a new market, and to think that you're just going to say, yeah, I'm going to start buying deals in X new market and I'll buy 5 deals in the first year and 10 deals the next year. I just don't think that's really realistic. It really does take a lot of time to build up your credibility, build up your expertise in the market, to have the confidence to pull the trigger and make deals happen. And then of course you need to obviously scale your operational capacity in line with that. So for us, we're growing very steadily, 1 deal a year so far in Dallas. So it's very easy for us to have the right personnel, have the right managerial oversight to ensure the success of those investments.
Yeah, and to kind of piggyback off that too, something to really think about is recalibrating your expectations based upon the different market. Not every market's the same, obviously. If you're buying in Alabama, New York, Texas, the pain points and how you underwrite deals is going to vary deal per deal. So what I mean by that is the cap rates are a lot tighter in Dallas than they are in Houston, which is our flagship market. So we have to get really comfortable with being uncomfortable, and we have to use our professional discretion to make sure that we are overpaying and are the highest bidder on the right opportunity. So for us to do that, we take that seriously, and we would like to, have a $500 million portfolio and get to 1% of unit share, which is the goal ultimately for every market that we get into, just for investors and capital raisers' perspective. So, the goal is to have 1% of unit market share in every market that we're in, right? But that's very hard to do when we are trying to not scale too quickly, go slow into something. And that's particularly challenging when you have to pay a lot of money for these opportunities. And the only way to justify those costs is to have rent growth, have an opportunity where you can improve that yield. Well, unfortunately, with where we're at right now in the cycle, with rents kind of staying stagnant, with the economy not looking so great, with supply coming online, it's been challenging to really get comfortable being uncomfortable in the Dallas market today. But at some point, that dam will break, the water will flood, and we'll be able to more comfortably and confidently underwrite rent growth projections, have there be a good story for us to feel comfortable to dive headfirst even more so into the Dallas market.
Yeah, good stuff. Okay, so just to round out a couple other unique things as far as 2023 acquisitions goes, we acquired Azul Apartments in Houston, which was 2020 vintage. So that's actually the newest project in our portfolio and the smallest project at 90 units. The reason that Azul was compelling to us was because it is located adjacent to Park of Champion Forest, right on the corner there. So it made a lot of sense for us to basically buy the deal next door and aggregate our management footprint there to from 232 units to 322 units. And we can do that seamlessly with more payroll efficiency. The other unique thing about Azul was that it was acquired with 1031 exchanges. So we actually had, I think, about maybe four 1031 exchange investors come in and make up the totality of that deal. And here we have a little note here that says, if you're interested in learning more about investing with us via a 1031 exchange, please reach out to Craig. The funny thing is Dasha
Joshua,
has
yeah,
really emerged as the 1031 exchange expert
it's her
in our
baby.
business. What was that?
It's her baby.
It's her baby.
Yeah, the 1031 exchange, and she's got a little special something coming out hopefully soon on that note. So that's a little teaser for you. We'll have her obviously spotlighted on this podcast once more once that is completed. And actually, it was five 1031 exchanges on that opportunity.
Yeah. Yeah. So for those that aren't familiar, obviously 1031 exchanges are a tax deferred exchange where you're able to sell property and roll the gains of that sale into a new property, and you're able to avoid paying any taxes through the exchange. And it's very popular, a very powerful tax saving strategy for real estate. And what's unique about us is we are, I would say, leaders in the industry at facilitating these 1031 exchanges from investors selling property that they may manage themselves or wholly own into a deal with us where they are a minority owner via their 1031 exchange funds, and they can take a more passive role as we actively manage the asset. So this is a very good opportunity for someone who is essentially a tired landlord but doesn't want to pay the taxes associated with selling out of their lucrative investment, and instead able to 1031 exchange and have it professionally managed and continue to see their equity grow and grow and continue to receive monthly cash distributions. So if you are interested in doing something like that and learning more, you can reach out to Dasha on our team. That would be Dasha, DASHA, at lscre.com. Moving on to the highlight as far as acquisitions goes for the year was our Houston 3-pack, or it was essentially a 3-property portfolio that we acquired in Houston. It really took us all year to do it. It was a big, heavy lift because it was the very first time that we acquired property in partnership with the Houston Housing Authority. So it's not the first time we had partnered with the Houston Housing Authority, because we had actually done conversions with them where we purchased the property and then later converted those assets into affordable housing partnerships with property tax exemptions. However, in this case, we actually did all the structuring up front prior to closing, so that on day one when we closed these assets, the properties were 100% property tax exempt. So that was very difficult. There was a lot of political stuff going on. 2023 was a turbulent time, not just for rates, but also for affordable housing in Texas specific to these programs. So that was a big, big challenge, and it turned out to be a good win. So that was
Well,
exciting. And
yeah, the great thing about that deal, sorry, just to cut you off here, but I can't help myself, is the amount of new partners we fortunately got in that opportunity is great. And so many people have said to me over the last year, meeting at the conferences, going through, kind of our meet and greets, the events we host and such, that deal is the best and most stable deal that is in their portfolio. And I think we're really fortunate that that's the case because, that recency bias is playing very well to us. And the fact that they have a good experience there will lead them to hopefully work with us on many more to come. The deal is cash flowing very nicely. We projected 5%, and here we are projecting 5%, and distributing 5%, excuse me. So the deal is just going exactly as we hoped, and very grateful for that. And performances are only going better here coming up. We've worked a lot of the delinquency there. We are working on the tenanting of it, fixing up some of the units and such. So overall, just a really good story.
yeah, a couple highlights there. Also, just speaking of, pushing performance and everything like that. Something else that comes to mind is I recently hired a utility consulting firm, and they've been doing an audit. And that actually at Meritage, one of the properties in the Houston 3-pack, they found billing errors that the utility companies were doing for a total of about 6,000 per month. So we should be looking at, for the Houston 3 property portfolio, an immediate savings. They'll be able to go back in time and moving forward save $6,000 a month on utilities, which is a huge number, because if you look at 6,000 times 12, that's 72,000. If you do a 5 cap on that, that's almost $1.5 million of property value
I
added
love
to
that.
this
That's a lot of
portfolio.
shareholder value. A lot of
Yes, it
shareholder
is.
value right there.
That most certainly is. So that's exciting. Just something fun that came to mind. There's also some other benefits at Meritage. Also in 2026, there's an ADT, like, security technology contract that the previous owner had locked in for 5 years, and it expires in 2026. It was actually a 7-year contract, and I cannot wait to walk away from that contract and cancel. And that contract also is $6,000 a month, just for some silly, like, alarms and doorbells and stuff like that, like smart locks, that we can easily replace and do for basically free in comparison to $6,000 a month. So that would be another 6K a month savings, which would add
That's
another
3 million
$1.5
bucks.
million of value to the project. So we're
Three
just
million.
staying super focused, staying just looking at ways that we can continue to create value. And speaking of monthly distributions, I know you love your monthly distributions, as do all of our investors. It is now past the annual or the first year of the 3-pack investment. And so we are going to be increasing distributions. I think we projected to bump them up to 7% for year 2. So I'm hoping we can hit that as we send out our new distributions coming in about a couple weeks or so. So yeah, really exciting stuff there. And yeah, great deal. So it's funny just reading through this. It's like going back memory lane. This is just so much fodder for content. So I
Going
don't
through
want
some
to,
trauma now.
yeah, I don't want to belabor this point. And, probably it is interesting for people, but for me, it's like I just want to move on and forget. But
Well, actually, sorry, before you go into it, this story has been reoccurring actually more recently. For those who don't know, I'm sure very few actually do, but if there are listeners who got the email and connected with us, we kind of reached out to all of our prospective capital partners to see if they're still in business, to see what they're doing, see what's going on. And funny enough, they referenced this story, and I kind of forgot about it because it was well over a year ago, but they referenced the story, funny enough, and we're just very impressed. Between this and you moving to Texas this year, these were the two themes of like, oh wow, I'm very comfortable and confident in this monster. So without further ado,
yeah, so 1001 Ross seems to be a bit of a cursed deal. So we put the property under contract back in May of 2023. And at the time that we went under contract, US Treasuries were about 3.5%. And once we went under contract a few months later, as we were approaching closing, treasuries were about 4.2%. So about a 70 basis point rise in treasuries. Does that sound familiar? What just happened with treasuries over the last 2 months? They went up about 75 basis points. So it was volatile then, and it continues to be volatile today, which is a separate point that I'd be interested in discussing. But anyhow, it was a great deal that we were super excited about. It's going to be a nice deal downtown Dallas. It was going to be our second deal in Dallas. We were very excited about it. But when you buy Class A property like this, a mid-rise asset, the cap rates are very tight, particularly in Dallas. So you're even more sensitive to interest rates. And so when your interest rate goes up by 70 basis points, it's going to cut your loan proceeds, and it's going to cut down your levered returns and your cash flow substantially. And so we try to go back to the seller and say, hey, this is not our fault. Treasuries just went up. It's out of our control. And we asked for a price reduction that it was a reasonable price reduction, and it would have got us, roughly back to our projected returns. But the seller said no. And so we ended up having to walk away from the deal and forfeit about $750,000 of our pursuit costs of earnest money deposit, loan deposits, due diligence costs, and stuff like that, and legal fees. And of course, that's nothing that our investors lost. The investor money was just sitting there in the bank, and that was Lone Star funds for pursuing the deal that we forfeited. And then we just took the investor funds that were sitting in the bank and we returned it back to investors. So investors weren't harmed. Thankfully, obviously, our reputation is more important. Our investors are the most important thing to us. But it was obviously a painful setback for us to, number one, not close the deal and forego the opportunity of earning those fees and adding that property to the Dallas portfolio, but then also the setback, of course, of losing our pursuit costs. So painful experience, but a good learning lesson. And like you said, it's a good story to be able to tell to investors to show our true colors a bit and make them more comfortable with us. And then,
Yeah,
like you alluded to, the story of 1001 Ross continues because actually a buyer put the deal under contract like 2 or so months ago when treasuries were again dipped down at 3.5, and then of course they're up now at like 4.3%. So that deal's falling out of contract yet again. So the
I did not
sellers,
hear that. I did not hear that additional caveat. That is really unfortunate, and I feel for the sellers. Maybe they should actually try to sell the property when treasures are high, so the movement will be downward to help them out.
I don't know what they need to do, but yeah, I mean, maybe if they want to sell it to us for 35 million, we'll buy it, irrespective of where treasuries are.
That's true. We'll make them an offer that we actually cannot refuse. But yeah, no, it's funny. When I think about my first full year, they kind of rounded up my first full year when that all occurred. I had to learn in a market how to raise capital when treasuries are moving wildly against you, and we can't buy that there. And then the three pack, I basically had to raise the capital on that deal 3 times to get everyone excited in the first go around. For those who were part of that deal, you remember these phone calls. My update being there was no update, but hey, everything is going okay. There's no news. So the news that there is no news, and then of course the final push to get it finally over the hurdle and the finish line to close. So I had to do that 3 times. Not easy, not fun, but that's the job, and I will be very happy about the outcome come 4 years from now when we do actually go, in fact, full cycle on this opportunity, and everyone's very happy, and we've doubled everyone's money ideally in that process, and we, can 1031 exchange into the next opportunity, and then 1001 Ross. So tough times, but I actually prefer to learn and be in a market where that's happening in the first year, as opposed to, the fifth year when I'm hoping for all these sorts of pops and, my comp to get really crazy. That's just a personal note.
So moving on in the letter here, we talked about Lone Star moving into a new market being San Antonio. So that was a decision that we made in the back half of 23. And then we were very fortunate to acquire our first project in San Antonio in 24 in March. That's called, formerly known as Aspire, and it's called today, we renamed the property to Regency Grove. And actually, if we have time in this podcast, I think we do want to make an update about that deal, which is a perfect segue. But before we do that, let's just breeze through the rest of the letter. One of our goals for 2023 was to start our first development project. I'm really glad that we didn't. I'm actually really glad that we're not doing development right now. I think we have plenty on our plate. We're plenty busy, and there's no need to complicate our lives or our business any more than necessary. I think Einstein said you need to make things simple, but not simpler than they need to be, or something like that. And yeah, so I'm happy that we made the strategic decision to not jump into something like that. So that's a interesting thing to look back on. From
We've
a
grown a ton.
yeah. So at the end of 23, we had acquired, inception to date, 514 million in deals. The portfolio was 3,600 units. Today, we actually sit at a little over 5,000 units. I think if you include Cortland Vizcaya, which we're closing in less than a month. So that's nice. That's good growth. I'd like to continue to see that pace increase even. So that's great. There's going to be a ton to talk about in the 2024 letter as far as portfolio management, and about the fact that I had moved down to Texas for over 5 months, and we made a lot of changes top to bottom. So that's going to be a lot to cover in that letter.
Your
And then
life has changed a lot in 2024.
yes, it for sure has. So we'll definitely cover, once I write the letter, once the 2024 letter, we'll obviously cover it here on the podcast, and that'll be some great content for everyone listening. This can't be minimized, but in 2023, we successfully navigated the complex refinancing of 6 of our properties into the property tax exemption program in partnership with the Houston Housing Authority. So these were huge wins, and we actually executed those refis in April of 23 when treasuries were near a bottom. So we actually refied all those deals in the low 5s for rates wise, which is really fantastic because rates today sit at over 6. So we just crushed it on those deals. Number one, by getting the property taxes exempted, taking away our biggest expense, and number two, fixing in the low fives. Huge win. So we got
And
10-year money.
a lot of it was 10-year and 7-year, which is excellent. I mean, no one knows where the market's going to go, but to have that number there, if the rates are higher for longer, well, do the math. That's, a rate that's not really around right now. Plus, you couple that with the exemption and also just a long tarmac there. Obviously, I think everyone wants to recycle dollars quicker, but more than recycling dollars quicker is not losing a buck. And the fact that we're at there and we're distributing capital in these deals is such a win.
Huge win. Really fantastic. So that those deals were previously floating. We refied into fix, low fix, as well as reducing expenses through the tax exemption. So all those deals are making distributions. And then here at the end of 23, we noted that we had 3 of 17 properties with paused distributions. We're at, I believe, 5 properties with paused distributions out of 22 right now. So overall, very stable, healthy performance. We're working through those loans with floating rate debt on them and some operational challenges, but overall, the portfolio is very healthy. We'll definitely detail all that in the 2024 letter. But yeah, things are looking very positive on the portfolio management side of things. One thing that we were working on in 23 and a big chunk of 2024 were low income housing tax credit applications for 2 of our projects, the landing at Pinewood Park and Solano. Both of those deals have paused distributions and have been struggling to cash flow. And the low income housing tax credit program would allow us to actually quasi sell the projects at a really great price, give investors a great return, and solve basically those issues there. Unfortunately, in the end, we were not approved for the LIHTC credits, and it just didn't work out. So that's just tough. I mean, we worked really hard to try to go above and beyond and find a unique solution to those challenges, but in the end, those deals are not going to work. We are pursuing potentially some other interesting strategies. We are going to be most likely receiving a 50% property tax exemption on the landing and looking to sell that in 2025. But obviously, I don't want to get ahead of myself here. We're still talking about 23 here. But yeah, it's just we're continuing to fight for every deal in the portfolio, for every investor that we're
For
partnered
every
with.
cent.
Mm-hmm. Um, yeah, so I'm going to skip the team stuff. I think we'll cover the team stuff, kind of the latest and greatest, when we cover the 2024 end of year stuff coming out in a couple weeks. Obviously, this is cool to see that we had launched the Fund to Fund program. I think kind of probably towards the end of 23, and this has become. I mean, it started out as kind of like a cool idea, and then it's grown to just a huge part of our business. Most of our capital partners that raise pools of funds with us do it in a fund to fund vehicle and do it through our fund to fund program in partnership with TribeVest. So that's been a great win and a way that we've just raised a ton more capital. I think by the end of 2024, we'll have raised somewhere around maybe 75 million in 2024. And I'd like to push ourselves and raise at least 100 million in 2025. So yeah, that pretty much rounds out
Let's
the
look at
letter.
looking forward, just
Oh
out of
yeah, right.
curiosity. Yeah.
Good, yeah. Good call. Good call. Okay, so at the end of 23, we had looked ahead to 2024, and our acquisitions target was 300 million, and we were wanting to do that across DFW, Houston, and San Antonio. We said we believe 2024 will end up being a fantastic year to buy real estate, as prices are going to continue to come down and interest rates may as well. So that has been definitely true, but partially true, because prices have come down in some cases, but actually have already rebounded in 24 as well. And while interest rates did come down in early 24, they've also rebounded quite hard in the back half, in the end of 24. So it's been a very bumpy ride, but so far we've gotten super lucky with locking in great prices as well as great rates on every single deal we've done in 2024. So it has been a really fantastic year for that. However, we're going to end the year at just shy of 200 million in acquisitions, which frankly I'm super happy with, because I'd rather do 200 million of fantastic buys than run around getting greedy or making mistakes for 300 million.
One really interesting thought we had and we were sharing. We can probably get out of screen sharing. Yeah. One really interesting thing that we were talking about the other night, or yesterday actually, I should say, was there are every company has its strengths, its weaknesses, right? Some companies are incredible at raising capital, but raising capital is all for nothing if you can't find good deals. Some groups are excellent, and I mean excellent at finding really sweet deals, right? They're awesome, they're unique stories, or at least they sell it like that, right? And maybe they're really excellent at that, but maybe they can't asset manage or they can't capital raise, which is all for nothing. And then some groups might be excellent, and I mean excellent at managing the real estate, but they have no idea how to market. They don't know how to play the popularity contest. They can't sell themselves, so therefore they can't capital raise, and they can't really find good deals and convey to sellers that they're the buyer for them. So what we're really working towards is the true and purest and best balance of those three, which is, and also just for those who don't know, we want to be a management company, a asset management, property management company that happens to acquire real estate and also market pretty darn well. So to couple all those three things together, those three sigils, if you will, is how you get the most robust and elite and dynamic company in the business. I would like you to just maybe expand on that a little bit more.
Yeah, sure. It basically, when you start in this business, you're excited about investing in deals, you're excited about buying deals, you're excited about financing them, about raising money. And when you start, your portfolio is a portfolio of none. And when you buy your first deal, all you're focused on is buying your first deal. Then you buy your first deal. Now you have a portfolio of one, and then you're looking to buy deal number two, right? So it's kind of like one deal, whatever, no big deal, and you're looking to buy one. So it's like your time is equally split. Your focus is split, one on the deal you have and one on the deal you want. But then slowly over time, you keep adding. And then before you know it, you're at 10 deals, you're at 20 deals. Now your portfolio is this big. And then buying a new deal is like this. So now it's like your focus, the firm's focus should be like this much on buying a new deal and this much on the existing portfolio. And that's a tough adjustment for a lot of companies because they were maybe initially attracted to the business, or their historical focus has been more so on acquisitions and raising capital and so on, and they're not used to actually understanding that, okay, no, I actually have over 100 employees and I actually have an operating company, and that is my entire focus. And so that's been our pivot, our paradigm shift in 2024, that's setting the stage for our massive success to come, because we're building a fantastic foundation that will allow us to scale from 5,000 units to 15,000 units or 50,000 units if we so choose. And that's really, really important.
Couldn't agree more. Well, I think we should just end it there. Go one concept on this, like we kind of did last week. Go really deep. Is there any kind of final thoughts or themes that kind of hit your mind? Maybe some reinforced concepts that you want to just maybe speak on prior to departing this show?
Well, I think we'll definitely have a chance to talk about some portfolio updates, specific deal updates like Regency Grove, which is a great update. November's almost over, so we're going to have our November collections numbers in, and we're going to be able to compare how all the deals are performing and whatnot. So I would just like to share more updates on what's happening at the portfolio level, just to get investors really clued in, get them really excited about investing in Lone Star's next deal.
Right. And then maybe as you look through and really kind of just recap and kind of feel some of the nostalgia from the year prior, perhaps, what are you really excited about and you think you overdid, and what's something that you think you could have some improvement on when you look back from 2023 to 2024? Where was there no meat left on the bone and where was there some meat left on the bone?
Well, I mean, looking back at 23, I think overall we had a great year. We did a good job marketing. We made the great decision to relaunch this podcast, and we've stayed consistent. I think we maybe missed 1 or 2 weeks of this show, but you and I have been consistent with this podcast, and you've been doing a fantastic job with Fun Friday. And like you said, those kind of our flagship marketing efforts at the moment, and they do bear fruit. We do get new partnerships, new investors, build our reputation in the community. So it is definitely for a purpose. We don't like to just do things for the fun of it. You and I are very purpose driven. So that's a big win. The the LSC Summit last year, or in 23. Yeah, in 23 was at the World Trade Center for the first time. Huge success. We just hosted it again for the fourth time, but the second time at the World Trade Center. And that was another huge success. Super, super cool. I encourage people to go on YouTube and look for those LSC Summit recap videos. Really cool.
And
We just
you get to listen to the best of the best on the equity side and the debt side, listening to what's going on in the market. Like that's something where if you want to reinforce some concepts and hear the best information from real professionals who are doing billions of dollars in equity and debt, there you go. Like that's invaluable. That's what people have paid thousands of dollars to be in the room for.
Yeah. Yeah. And I think just looking back at 23 and then thinking back to 24 now, one of the things that I think we have done very well in light of how difficult it is hiring. I think hiring is super challenging. And this year we brought on Culture Index as a consultant for helping us hire and promote talent. And that's been something I'm very passionate about, really excited about. We'll be doing our second Culture Index workshop as a company in March of 2025. So we're continuing to invest in that skill set because it is one of the most important skill sets in the business, and it's just critical. So, yeah, exciting stuff there. I'm just looking over at my notes here as I prepare to write the 24 annual letter. We did so much. I mean, we brought payroll in house. We revamped our utility invoice processing process, and we switched RUBS companies from Resynergy to Zego. We rolled out the new PUU bonus program. We created a takeover squad and brought DD in house. The changing of roles between me and Kent, hired a bunch of new VAs. We removed the layer of regional managers and vice presidents at the management level.
Sounds
Revamped.
like so. My comment when you list all these things out is maybe from the outside you don't realize how important these things are. Maybe you don't realize it, uh, but these things are invaluable. They are so crucial. I can't express to you enough how important it is to have all these things lined up, how important it is to um, truly do these things. And they're not the big sexy splashes, but they're in the trenches that actually give you the desirable outcome as an investor or capital raiser that you want to actually have. And that's the most important thing.
Yeah, most definitely. And then, cool. I need to look at the actual numbers, but at this point, we've sold over 30,000 copies of our two books. So it's just cool to see. Definitely sales have slowed down a lot. I think it's just people just generally are less interested. There's not this fever about multifamily investing as it was when rates were zero.
The market's
So
being crushed right now. Let's just call it what it is. Yeah.
yeah, so people are less interested in buying books of this nature, but the sales are still chugging along.
Yeah, excellent. Well, we're going to wrap up there. Thank you, everyone, for listening. If you are a fund manager or an investor looking to learn more about Lone Star Capital, please reach out to myself. Also, we'll be having an event in Menlo Park, California. So that would be on the 18th, I believe, of December. So if you're interested in potentially attending, if you're a prospective investor or fund manager looking to learn more about Lone Star Capital, whether you've got some tax depreciation needs you're looking to solve for, if you've got a looming 1031 exchange, if you're looking to make an investment, reach out to myself and perhaps we can get you on the list if it's a good fit. Thank you, everyone.